Imagine walking into a grocery store to take advantage of a massive sale, only to find the shelf is completely empty. Instead of leaving empty-handed, you head to the register and secure a rain check. You pay nothing right now, but you lock in that discounted price for a future date when the item is back in stock. This simple act of locking in a future price today is the foundation of how stock market options work. Options are formal contracts that give you choices to execute a transaction at a later date. We will start by looking at the two main types of options, calls and puts. Next, we will define the roles in these contracts, looking at the difference between being the long buyer and the short seller. Then, we will combine those concepts to master the 5 basic strategies every beginner needs to know. Mastering these basics allows you to build a plan to profit whether the market is moving up, down, or entirely sideways. A call option is the financial version of that rain check. It gives you the right to buy a stock at a specific price, making it a bullish bet that prices will rise. This chart from Fidelity defines the second type, the put option. Think of a put as an insurance policy. It gives you the right to sell a stock at a specific price, protecting you if the stock price crashes. It comes down to direction. Call buyers want the price to go up, while put buyers want the price to go down. Going long means you are the customer, paying an upfront premium fee for the contract rights. Going short means acting like the business, collecting that fee immediately. However, the seller has a strict obligation to fulfill the deal if the buyer executes it. When you are long, your risk is limited to the fee you paid. When you are short, you get paid up front, but you face the risk of a large payout if the market moves against you. Strategy 1 is the long call. As this blue line shows, you pay a small fee now for the chance to make a profit that grows as the stock price moves higher. Strategy 2 is the covered call. This involves owning the actual stock and selling someone else a rain check on it to generate a steady stream of income. This limits your potential upside, because if the stock price skyrockets, you are forced to sell your shares at the lower price you previously agreed upon. Strategy 3 is the short call. This is a high-risk move, where you sell a rain check on a stock you don't own. If the price falls, you keep the fee, but as the blue line shows, you face massive losses if the price rises. These strategies range from conservative to highly risky, depending on whether you own the stock and whether you are the buyer or the seller. Strategy 4 is the long put. As the blue line moves up while the stock price moves down, you can see how this acts like insurance, letting you profit if the stock price drops. Strategy 5 is the short put. You're acting as the insurance company. You collect a fee today, but as the curve drops, you can see the risk you face if the price falls and you are forced to buy the stock. Puts allow you to either protect your own investments from a crash or earn money by insuring the assets of other traders. Options are a customizable toolkit. By mixing buying and selling with calls and puts, you choose your exact level of risk. These same rules don't just apply to individual company stocks, they also apply to contracts that track the broader market. This chart shows how you can trade contracts that track an index of hundreds of different companies at once. These trade nearly 24 hours a day, effectively letting you buy a rain check on the entire market. Whether you trade a single company or a whole indexed, these mechanics are a universal language for navigating market movements. The most important rule to remember is that options use a magnifying effect. Because a small amount of money allows you to control a much larger amount of stock, your gains can be amplified, but your losses can be accelerated just as quickly. You must determine a strict budget for how much risk you can take and have a firm exit plan in place before you ever enter a trade. Use a simulator to practice these 5 strategies with play money before you risk any of your actual savings. Successful trading isn't about predicting the future, it's about mastering the mechanics of managing your risk.